I'm Stacey Marie Ishmael, managing editor of crypto for Bloomberg News. And this is Bloomberg Crypto, a new daily Bloomberg iHeart podcast. Welcome. It's Thursday, June 2nd. On today's episode, our very first, Bloomberg reporter Olga Karif will help us all understand the absolute meltdown of the Terra stablecoin. And frankly, if stablecoins are actually stable. Whether you're casually crypto curious or totally coin-pilled, or even a complete skeptic, there'll be something in this episode for you. But first, I wanted to introduce myself and this podcast. Have you ever wondered how you make a Bitcoin? Or how a blockchain works? Or why anyone would spend money on digital pictures of monkeys? We've got you. I've got you. I'm Stacey Marie. I've been a journalist, a product manager, even a podcast host. And I've spent my whole career at the intersection of technology and media. Right now, I'm the managing editor of crypto for Bloomberg News, and your host for this Bloomberg Crypto podcast. On this show, we'll be exploring fundamental questions about this wild crypto universe, and we're hoping you'll send us your questions, too. Alongside my colleagues from around the world, I'm committed to bringing you the crypto news that matters, to help you understand the who, the what, and the how. And of course, why any of this matters at all. Crypto is an asset class, an industry, a collection of contradictions, and for some people, a way of life. And it's shaking and shaping global financial markets every single day. Whether you're a Bitcoin maximalist, a digital asset skeptic, or simply crypto curious, this is a show for you. Beyond the ups and downs and volatility of the market itself, we'll look at crypto's impact on art.
They're non-fungible tokens. They basically just allow holders of like an art piece or a collectible to track ownership of that art on the blockchain.
On politics.
And that's something important to talk about too, is this relationship between the regulators and Congress. They have tremendous agenda-setting powers.
On culture.
You know, if Justin Bieber buys a Bored Ape Yacht Club, which he did, I think a lot of the community takes that as a stamp of approval.
On regulation.
The most efficient way to mine Bitcoins, which is to create Bitcoins, is to go to a place with the cheapest electricity possible and the less regulation possible.
On society.
We've really seen an upswing recently in people using social media as a tool to rip off crypto investors.
And of course, investors.
You know, I'm thinking about the people who are investing in these kinds of services and the people who end up losing money. And, you know, you could argue that this is ultimately just the rough path that decentralized financial services have to go through to become more secure.
And we'll define our terms along the way.
Metaverse, an immersive version of the internet, where you interact and play games as a digital avatar.
Join me each weekday to stay up to date on the most interesting and important crypto news. We'll be right back. Now, on to our guest today, Olga Karif, who'll explain just what an algorithmic stablecoin is, or was, in the case of Terra USD. Our guest today and our first guest on this podcast, I'm very excited to introduce you all to Olga Karif, who is one of my colleagues here on the crypto team. Olga is going to help us all understand what stablecoins are. We know that some of them just aren't stable, and also why this concept in crypto has really come into, I think, mainstream attention over the past few weeks. Olga, thanks so much for joining us.
Thank you so much for having me on your podcast. I'm so happy to be here. You know, stablecoins, of course, have been around for years. And the idea here is to allow crypto investors, for instance, to kind of stay in crypto, not have to go into fiat at times of high volatility in the markets. And so years ago, traders started using a stablecoin called Tether to exit positions in various coins and go into Tether which is pegged 1-to-1 to US dollar at times of high volatility. More recently, stablecoins have been in the news for sort of an unfortunate reason, because one stablecoin called Terra USD collapsed, and it basically led to the destruction of more than $40 billion in market value.
Okay, $40 billion is a non-trivial amount of money. And I would love for you to explain a little bit more, first, how Terra USD is different from something like Tether, and even more importantly, how it caused that value destruction.
So the name stablecoin can be deceiving. They're called stablecoins because they're supposed to be relatively stable, whereas a lot of other cryptocurrencies are wildly volatile sometimes. And so each stablecoin is supposed to be pegged to, say, $1. The problem is different types of stablecoins achieve this peg differently. So Tether, for instance, is at least supposed to be backed by cash-like assets.
And when we say backed by, what we mean is if you were to peer into Tether's accounting books, for every Tether in circulation, there should be an equivalent amount of US treasuries or dollars or something else that they could, if they had to, sell in order to make somebody whole for the value of their thing.
Right, exactly right. And then we have Terra USD, which did not work this way at all. So it's one of the so-called algorithmic stablecoins that essentially use algorithms and different trading incentives to maintain their one-to-one peg. And according to one academic paper that I've seen in recent days, it's an impossible task, essentially. This is kind of the conclusion right now, especially after Terra USD has failed. Essentially, the way Terra USD's peg worked was it was pegged to another coin called Luna, and essentially one Terra USD was always supposed to be equal to $1 worth of Luna. And this is how it functioned for a while, and it worked until it didn't. And essentially what happened was there was a bank run kind of an event. And in this event, basically the most basic part about how the stable coin functioned did not end up working. So technically, when, say, Terra USD dips below $1, you're still supposed to be able to recoup $1 worth of Luna. What we've seen is sort of the price of Luna started dropping, and so you needed more and more Luna.
So you needed more and more Luna to buy one Terra USD.
That's right. And essentially, what we've seen in a matter of days, both Terra USD and Luna values dropped into cents and then below cents. And that's how we've seen this billions of value destroyed. Basically, these were pretty large cryptocurrencies by market cap, and this market caps just evaporated in a matter of several days.
Now, you said what we saw was kind of the equivalent of a bank run. And when folks think about bank runs, this is not sort of somebody coming in with like, stick them up, put your cash on the thing. This is more about a collapse of confidence, a disbelief that the bank can, if you were to go and say, I would like to withdraw the money from my savings, that the bank would be able to give that money to you. And so it sounds to me like what you're describing was like a mass psychological effect of people who had previously believed whatever Terra USD's value proposition was, suddenly all coming to the conclusion that actually there's nothing here.
That's right. You know, if you look at the aftermath, there was nothing there because there were different ideas for how this stablecoin could be bailed out, how the situation could have been made better, but none of it ultimately came to much. And so right now, the community behind Terra USD is trying to rebuild, and there is a new blockchain that's being kind of rebuilt. But ultimately, what we've seen is people lost confidence in the project and in this cryptocurrencies, and ultimately they were completely decimated within several days.
They didn't only lose confidence, though, they lost money.
Yep.
Right? Like we've been reporting, others have been reporting. There were some nice pieces in addition to ours in the Wall Street Journal and in Rest of World about how people all over the world who had thought, oh, this thing seems stable. It's got stable in the name. I'm going to put some significant amount of my earnings or my savings into this. In practice, though, I think sometimes it's hard for people to be like, but I don't understand how you lose money on crypto. Like, how does that work practically?
So I think that's a great point in the sense of, sometimes we forget that some portion of people who invest in crypto, they're speculators, they're investing money that is extra that they don't necessarily need for day to day. And then we have a lot of people who perhaps, especially from developing countries, are investing in crypto because perhaps their own currency is very volatile. There is so much distress from people who lost money here.
And some of the ways it seems to me that they lost money is, baked into this expectation was not just if I spend $1, I'll have $1 worth of Terra USD, but the reason that people were doing that, the reason people were investing in this wasn't only for the stability, which was important, it's because they were getting pretty high interest rates, right? Like a big value proposition of this whole ecosystem was if you quote unquote save your Terra or your Luna on certain parts of, the crypto ecosystem, you would get the equivalent of returns that there's no way to generate that on a traditional bank account. So people were arbitraging the fact that, if you have a savings account, you might get 1% interest on whatever you have in there. But if you had Terra USD, you were getting up to 20% of what you had in there.
Right. So basically, if you had Terra USD, you could invest it into Anchor protocol on the Terra blockchain and get this crazy 20%, up to 20% returns. And I think that's one of the maybe lessons here is that there are a lot of crypto projects that seem too good to be true. And that if they seem too good to be true,
they are too good to be true. Yes, definitely. Now, there's many parts of finance that have, over the decades, offered, shall we say, above average yields. That has generally ended poorly for all involved, but it does feel like this collapse had a more significantly retail effect than institutional, that the people who were really hurt here were the folks in places like Argentina or Brazil who were trying to, get either a little bit more stability than was offered by their local currency or tap into that 20% yield. Have we seen additional regulatory context or questions about any of this in light of the effects on that retail investor base?
Absolutely. And I think that's the big sort of effect that Terra will have perhaps historically on the crypto space. Pretty much all regulators that look at the space in the US have commented on what happened with Terra USD, SEC, etc. Janet Yellen talked about it.
The use of digital assets is rising very rapidly. They present the same kinds of risks, of run risks and other risks, payment system risks. And really, we need a comprehensive framework so that there are no gaps in the regulation.
And so I think the result of this collapse will be perhaps more urgent development of regulation of this space. I think it's going to be a good thing because for several years now, a lot of people and institutional investors have stayed away from DeFi because it's so unregulated. It's the Wild West of crypto. Perhaps as more regulation trickles in, there will be big changes in how DeFi functions, but there will perhaps be also more capital flowing into it and more investors, serious investors, giving it a shot.
And when we talk about DeFi, you mentioned Anchor protocol earlier. What we're talking about is the ways in which crypto and people who believe in crypto are trying to rebuild more traditional financial services and offer things like lending or like interest or yield-bearing products. Is that right?
Right. So in theory, at least, this could lead to additional efficiencies.
But in practice, what we have with DeFi, at least in its present state, is people losing money either because these projects got hacked, which we'll talk about more in future episodes, or because the project itself just collapsed into nothingness.
Absolutely. It's such a very, very risky space. I mean, all of crypto is I would say very risky. And in this very risky space, DeFi is the riskiest.
Buyer beware, as they say. All right. Well, Olga, thank you. I really appreciate you joining us to be our first guest on this podcast and helping the world understand algorithmic stablecoins just a little bit better.
Thank you.
You'll find more of Olga Karif's reporting on the Bloomberg terminal, on Bloomberg.com, and on Twitter. She's Olga Karif. That's Kharif. On the next episode of Bloomberg Crypto, cryptocurrencies are increasingly popular as investments. Everyone from traders on Reddit to big institutional shops seem to have some kind of crypto strategy. But what happens when the people investing in this asset class are also the ones in charge of regulating it? What are the ethical implications of having members of Congress buy Bitcoin? Tomorrow, a chat with Bloomberg reporter Akela Gardner about how to regulate the crypto regulators. I'm Stacey Marie Ishmael, and this is Bloomberg Crypto, a daily podcast from Bloomberg and iHeartRadio. For more shows from iHeartRadio, visit the iHeartRadio app, Apple Podcasts, or wherever you get your podcasts. Email your comments, questions, or suggestions to crypto@bloomberg.net. Follow us on Twitter @crypto. The producer and editor of this episode is Vicky Vergalina. Our engineer is Blake Maples. Original music by Leo Sidran. Bloomberg's head of podcasts is Francesca Levy.